If you are 65 or older and you have a bank account in America, your bank is required by federal law to file reports about your financial activity to the IRS. This is not because you are suspected of wrongdoing, but because the Bank Secrecy Act mandates reporting. In 2026, 3 common mistakes by seniors are causing audits, account freezes, and levy actions at unprecedented rates. This information comes from IRS Publication 594, the Bank Secrecy Act Enforcement Manual, and FINRA regulatory notices. The reality is that most seniors believe their bank account is private. Under federal law, it is not. Every deposit, withdrawal, and transaction is tracked, reported, and cross-referenced with your tax return by automated systems. The first mistake appears in your mailbox every January. The second mistake has been a federal violation since 1986. The third mistake begins with a letter that appears to be routine correspondence. Here are all 3 mistakes and why your bank cannot warn you about them. The first mistake, unreported interest income. Your bank is required to report all interest income on Form 1099-INT to the IRS. The reporting threshold is $10, though many banks report all interest payments regardless of amount. If you earn $22 in interest on a savings account and fail to include it on your tax return, the IRS Automated Underreporter program detects the mismatch. The system generates a CP 2000 notice proposing additional tax. Many seniors discard this letter because the amount seems insignificant, but the notice is a formal document requiring response, not optional correspondence. A retired postal worker in New Mexico named Raymond received a CP 2000 notice for $31. His bank had reported $31 in interest from a certificate of deposit that matured in 2024 and automatically renewed. Raymond did not include it on his return, believing the amount was too small to matter. The IRS proposed $4 in additional tax plus $8 in penalties. Raymond discarded the notice. 6 months later, the IRS assessed the balance. 3 months after that, they issued Letter 1058 LT11, the final demand before levy. By the time Raymond returned from visiting his grandson in Colorado, the 30-day response window had expired. His bank received Form 668-B and froze his account for 21 days. The levy totaled $295. The bank charged a $125 processing fee. Raymond paid $420 because he ignored $31 in interest income. Tax professionals report that in 2026, nearly half of new senior clients have unreported interest or dividend income. This is not intentional tax evasion, but rather lack of awareness that all interest is reportable income. Banks do not send warnings. They send 1099 forms directly to the IRS before the account holder receives their copy. If you maintain 3 savings accounts at 3 different banks, you receive 3 separate 1099-INT forms. Forgetting to report one triggers the automated detection system. The amount, whether $15 or $1,500, does not determine severity. The mismatch itself initiates the collection sequence. The IRS enforcement sequence is statutory and does not adapt to personal circumstances. A CP 2000 notice provides 30 days for response. Non-response converts the proposed assessment into an assessed balance. The IRS adds penalties and interest, then sends CP 14, CP 501, CP 503, CP 504, and finally Letter 1058. This final notice provides 30 days to file Form 12153, a request for collection due process hearing. Missing this deadline results in levy issuance. Your bank receives Form 668-B, freezes the account for 21 days, and transfers funds on day 22. There is no limit to repeated levies. If one levy does not satisfy the debt, additional levies continue until the account is depleted. The second mistake, structuring cash deposits. This is not a tax error. Under 31 U.S. Code, Section 5324, it is a federal felony, and it often begins with good intentions. A retired farmer in Kansas named Lloyd sold his combine harvester for $11,500 in cash. He entered his community bank and asked the teller whether he should deposit the full amount. The teller informed him that banks must file a report for deposits exceeding $10,000. Lloyd believed he was being strategic. He deposited $6,000 on Monday and $5,500 on Wednesday, staying below the threshold. He avoided the form and committed structuring. Under the Bank Secrecy Act, every bank must file FinCEN Form 104, Currency Transaction Report, for deposits over $10,000. Congress established this $10,000 threshold in 1970. Adjusted for inflation to $2026, the threshold would be approximately $80,000, but Congress has never updated it. Banks file these reports automatically without seeking permission or providing the account holder a copy. Most seniors are aware of the $10,000 rule. What they do not understand is that attempting to avoid it triggers a Suspicious Activity Report, SAR, instead. When Lloyd divided his deposit into 2 pieces, the bank's detection system flagged the pattern as structuring. The SAR went to FinCEN, Financial Crimes Enforcement Network. FinCEN shared the report with the IRS, which initiated civil asset forfeiture proceedings. The IRS froze Lloyd's entire account, not only the $11,500, but his entire account balance of more than $16,000. It required 13 months and $5,200 in legal fees to recover the funds. Lloyd was never charged criminally. Under the statute, the act of deliberately deliberately breaking up the deposit constitutes the violation. Intent is legally irrelevant. The algorithm detects the pattern and does not evaluate intentions. The problematic aspect of this law is that the $10,000 threshold has not adjusted for inflation since 1970, when enacted during the Nixon administration. The law treats retirees who sell equipment, vehicles, or inherit property identically to those engaged in money laundering. If you have legitimate cash to deposit the full amount regardless of the $10,000 line. Currency transaction reports are routine and do not trigger enforcement action. Suspicious activity reports are dangerous and activate investigation. Documentation is your only defense. Keep bills of sale, estate letters, closing paperwork, and receipts. If the algorithm flags your account, you must explain yourself to a system that does not consider context. The third mistake: unreported self-employment income. If you earn $600 or more in non-employee work from a single client during the tax year, that client must issue Form 1099-NEC, Non-Employee Compensation. This form goes directly to the IRS. If you do not report that income on your tax return, the automated underreporter program detects it automatically. However, most seniors misunderstand the threshold. The $600 requirement is per individual client, not for aggregate income. If you earn $500 from each of 5 different clients, no single client issues a 1099-NEC. However, you owe tax on the total $2,500 income. If the IRS conducts an audit, they do not focus on whether any single client crossed the $600 threshold. They examine whether you reported the total self-employment income. A retired chef in Louisiana named Marcus did not update the POD beneficiary after his wife died in 2023. The form still named his ex-wife from a marriage that ended in 2001. When Marcus died in 2026, the ex-wife received a $13,000 balance. His 2 children received nothing. The bank consulted the POD form. The children spent 10 months in probate court attempting recovery, spending $2,800 in legal fees. The ex-wife retained the account. The solution is free. Call your bank. Request the current beneficiary designation on file for every account. If it is incorrect, complete a new beneficiary form. It takes 5 minutes per account. It prevents months of probate delay and ensures the correct person receives your funds. Compounding effects of multiple oversights. Consider a retired couple, both over 65, with $15,000 in a low-yield savings account, a joint checking account with an adult child, and a consulting engagement that generated a 1099-NEC they did not report. If they take no action, the first-year consequences are severe. The cash loses $375 to inflation while earning $91 in interest. The 1099-NEC triggers a CP2000 notice. They do not respond within 30 days. The proposed tax becomes an assessed balance. The IRS issues Letter 1058. They miss the 30-day window. The bank freezes the account for 21 days. The Social Security deposit is seized. The joint account is frozen in a subsequent lawsuit. The POD designation names an ex-spouse unseen for 20 years. The $15,000 is depleted, not in a single event, but in 5 smaller incidents that accumulate, each manageable in isolation, but collectively catastrophic. However, proactive action before the year ends produces immediate savings. Moving cash to a high-yield savings account earning 4% generates $600 instead of $91 annually. Reporting 1099-NEC income on the tax return before the IRS detects it eliminates CP 2000 notices, levies, and freezes. Retitling the joint account as a convenience account protects assets if the child faces legal action. Updating the POD beneficiary to the correct child ensures proper distribution. Filing the tax return with all income reported eliminates mismatches. The IRS has no reason to initiate enforcement. Your money remains accessible and under your control. Immediate action steps. First, move your cash to a high-yield savings account if your current rate is below 3%. The difference between 0.61% and 4% on $15,000 is $509 annually, approximately $42 monthly. For retirees on fixed income, $42 represents medication, heating costs, or groceries. This transfer requires approximately 10 minutes. Second, gather documentation for every cash deposit made in the past 12 months. Collect bills of sale, estate distribution letters, closing paperwork, and receipts. If you sold a vehicle for $12,000 and deposited it in segments, you are in the algorithm's focus. Create a labeled folder containing every receipt. Without documentation, you are explaining yourself to a computer system. Third, call your bank and request the current beneficiary designation on file for every account. Do not assume your knowledge is current. Ask the bank representative to read the form to you. If it names a deceased spouse, ex-spouse, or incorrect child, complete a new form immediately. This requires 5 minutes per account, prevents months of probate delay, and ensures correct distribution. Fourth, if you have a joint account with an adult child, ask your bank about retitling it as a convenience account. If your institution does not offer this option, establish a durable power of attorney. The child can write checks but does not own half the balance. If the child divorces or faces legal action, your money is protected. The difference is 1 form, 1 signature, and 5 minutes, potentially saving thousands in attorney fees. Fifth, If you received any 1099-NEC or 1099-INT forms, verify that the corresponding income is reported on your tax return before filing. Do not wait for all forms to arrive. Some payers file late or forget entirely. You bear responsibility for reporting income whether you receive the form or not. Compare your bank deposits to your tax return. If deposits exceed reported income, identify the gap and report it. This gap is what the computer sees. The computer does not forgive omissions. The rules are not simplifying. The automated detection systems are not slowing. The thresholds are not adjusting for inflation. Your only defense is understanding what the computer identifies before it identifies it. A retired architect in Oregon named Stanley provided $3,200 in consulting services to a local developer in 2026. The developer paid $1,800 in March and $2,400 in September. Both payments individually exceeded $600, so the developer was required to issue Form 1099-NEC but failed to do so. Stanley assumed the absence of the form meant he need not report the income. He deposited the checks into his account and reported zero self-employment income on his return. In August, the IRS automated underreporter compared his bank deposits to his reported income. The system identified $3,200 in deposits but zero reported consulting income. The mismatch generated a CP 2000 notice proposing $380 in additional tax plus $77 in penalties. The government does not hold the account holder responsible for the client's filing failure. You bear responsibility for reporting all income whether you receive the form or not. Your bank deposits constitute IRS records. If deposits exceed reported income on your tax return, the difference triggers automated detection. A retired nurse in Washington named Patricia earned $2,400 from tutoring in 2026 and had $48 in interest from a savings account she overlooked. The tutoring deposits triggered a 1099-NEC mismatch. The interest triggered a 1099-INT mismatch. The IRS sent two separate CP 2000 notices. Patricia responded to the first but assumed the second was a duplicate and disregarded it. The second notice became an assessed balance. 3 months later, the IRS issued Letter 1058. Patricia was attending her daughter's wedding in California when the letter arrived. The 30-day response window had expired by the time she returned home. Her bank froze her $14,000 savings account. Her Social Security deposit was seized. She lost $465 total because she missed 2 notices for what she believed were small amounts. Bank deposit analysis and documentation requirements. The IRS does not simply wait for banks to send forms. Under 26 U.S. Code Section 7609, the IRS has statutory authority to issue a summons to your bank, demanding records of every deposit, withdrawal, and transfer for up to 3 years. Banks must comply. They cannot refuse, and they are not required to notify you in advance. Once the IRS obtains your records, they conduct a bank deposit analysis. They total every deposit that is not documented as a loan, a transfer from another account, or a gift accompanied by a gift letter. If the total exceeds your reported income, the IRS assumes the difference is unreported income. The burden of proof shifts to you. You must demonstrate that the deposits are not taxable. This is sometimes called a guilty until proven innocent standard. The only defense is documentation. If you receive a large sum that is not income, inheritance, loan proceeds, or account transfers, maintain the paper trail. Keep the estate letter, loan agreement, or bank transfer documentation. Without these records, the IRS presumes the deposit is taxable income. If you sell a personal item at a loss, keep the original purchase receipt proving you did not realize a gain. If you receive a gift, obtain a written letter from the donor stating the amount and date. If you receive a loan, execute a promissory note with repayment terms. These documents are your defense if the IRS examines your account. They are worthless if created after the transaction. You must create them contemporaneously when the transaction occurs. Temporary account holds under FINRA Rule 2-165. There is a rule that freezes bank accounts without court order. FINRA Rule 2-165 requires banks to place a temporary hold on account disbursements for individuals age 65 or older if the institution reasonably believes financial exploitation may have occurred. The hold can last up to 15 business days. State regulators can extend it for an additional 10 business days, totaling 25 business days. During this period, you cannot access funds. Checks bounce. Mortgage payments fail. Social Security deposits sit frozen. The bank does not need to prove exploitation occurred. They only need a reasonable belief based on account activity. A 79-year-old woman named Helen had $18,000 in her checking account at a regional Florida bank. She added her granddaughter as a joint owner to help pay utility bills while Helen recovered from hip surgery. The bank's system flagged both the new joint owner and a $9,000 wire transfer to a home health agency. The algorithm triggered a 15-day hold on the entire account. Helen's Social Security deposit arrived on day 3 of the hold. It was frozen. She could not pay her Medicare premium or purchase prescriptions. It required 4 days of phone calls to the bank's compliance department to release the hold. The granddaughter was not engaged in fraud. The home health agency was legitimate. legitimate. The bank's algorithm detected the pattern and acted automatically. According to consumer protection professionals, such cases are becoming routine, not exceptional. Banks face significant liability for elder fraud incidents, so they apply restrictive policies, erring on the side of freezing accounts first and investigating afterward. The account holder bears the costs. In 2026, with elder fraud complaints increasing, these holds are triggering more frequently than historical precedent. What was previously rare is becoming standard procedure. The definition of reasonable belief is intentionally vague. A teller who perceives confusion, a branch manager who misinterprets a wire transfer notation, or a software update that flags large transfers on joint accounts can all trigger the hold. You face 5 weeks of bounce checks, missed payments, and explaining yourself to an institution that already controls your funds. Joint accounts and payable on death designations. Adding an adult child to a joint account appears protective but creates unintended legal consequences. Under law, the child immediately owns half the account, not upon your death, but today. If that child divorces, the account is marital property subject to division. If that child is sued, the account is attachable by creditors. If that child dies before you, their heirs own half your account. There is no mechanism to reverse this without the child's signature. A retired engineer in Colorado named Richard maintained a $16,000 joint account with his daughter. The daughter was sued by a former business partner over a contract dispute. The attorney subpoenaed all accounts bearing the daughter's name. The $16,000 was frozen during proceedings for 9 months. Richard could not access his own money. He obtained a home equity line of credit to pay property taxes. After the daughter settled, the account was released. Richard learned an expensive lesson. The difference between a joint account and a convenience account is one form and one signature. A convenience account permits the child to write checks but does not convey ownership of the balance. At your death, the account passes to your named beneficiary, not the child. If the child divorces, the convenience account is not marital property. If the child faces legal action, the account is not attachable. The joint account creates all 3 risks. The solution requires one form at the bank, one signature, and approximately 5 minutes. For payable on death (POD) designations, verify that the named beneficiary is alive, competent, and the person you intend to receive the funds. If your POD beneficiary is your spouse and your spouse dies before you, the POD fails and the account enters probate. If you name one child as POD beneficiary and have 3 children, that one child receives the entire balance, regardless of what your will states. POD designations override wills. If you named your ex-spouse as POD beneficiary 20 years ago and never updated it, the ex-spouse receives the money. The bank consults the POD form on file, not your divorce decree.